Hello and welcome to Wealth Within Live. Well, Wealth Within almost live, and welcome to 2021. And I really do hope that all the troubles of last year are behind us and we have a fantastic year. I am confident on the stock market for 2021. I think it's going to do reasonably well, and those who are astute will profit greatly during 2021. Again, I do hope you've set down your goals for 2021. I've been asking you about that the last few weeks, and I know on our last live show last year, Janine did say to you, now's the perfect time to sit down, think about what you really want to achieve in the coming year or coming 5 years, and write that down. And then all it is about putting the steps underneath that, or the micro steps underneath that, and then putting some action into it, and you can achieve whatever you want. If your goal is, or your desire is, to be able to invest and trade the market better, but stay watching our show every single week. We're going to bring a whole lot of great content. We've got some new ideas for this year, which we'll start introducing probably from February this year, so watch out for that. Again, we've got some new and exciting content that you've never seen before on YouTube. But tonight, our first section is going to be discussing what the bubble is and how it is caused by herd mentality. So we're actually going to go into that, because it really does help you understand herd mentality and what causes bubbles, so that you can be aware of when the market or a stock is peaking out and getting out of that before you get caught in the inevitable crash or the big fall there. So let's take that one away.
Hit that subscribe button and like the video. Also remember to share the video of tonight's show on your social media with your friends and colleagues, so the show can grow and help more people.
Have you ever shared it with me? Janine doesn't have social media, guys. She just does not have social media.
So what are the masses doing? Well, they're chatting in social media, along with being bombarded with ads saying how easy it is to trade, and many have been enticed by free brokerage and other incentives to trade the market with little or no knowledge. Now, thousands of people who previously had no time or inclination to get into trading have turned to the stock market in droves in an attempt to profit. Now, they've become part of what we call herd mentality, and that fuels the stock market. And when individuals do this en masse, it creates a bubble. And this is why we believe that COVID-19 isn't the biggest trading risk that many are facing right now. One of the biggest trading risks right now is easy access that traders have to day trading complex investment products through emoji-filled phone notifications that make trading the stock market feel like a game. Now, technology is accelerating what's going on. So we want to share with you an understanding of how bubbles form and provide insights about what to avoid in the current bubble so you won't become a statistic. Dale will explain what a bubble is and how they occur so you can avoid being caught out.
Really good. Very good. Can I say, a lot of people think bubbles are just the stock market as a whole. So that the first myth I want to bust is stocks go into bubbles and stock markets go into bubbles, and you can have multiple stock markets within bubbles at any one time. But bubbles can happen in, as I said, in markets, in individual stocks, right across the board. And that's really what the first thing we need to understand. And right now, we're not really it's not normal, is it, at the moment? If we think there's a lot of signs that we're in a bubble right now, but it's not a typical type of bubble which normally happens at the end of the GFC, where you get this vertical rise of the market. It's new all-time highs. We've had this big meltdown into March, take off 38%, and now we've been sideways for the last 4 weeks, but a lot of the signs we're seeing are bubble-ish like, and that's what we're seeing here. And so we're actually seeing a lot of, as Janine said, a lot of apps, that sort of stuff, going into people seeing their phones. Only today I went onto some website, and all of a sudden it pops up, buy this stock, commission free, blah blah blah, click this button, and I'm thinking, what the hell? It's helping. This technology is allowing a lot of people to necessarily turn their brain off, I'd say, and click on it and go, oh, that's pretty cool. I can do that and make some money on the stock market, and we're seeing that a lot. And so to me we need to be very, very careful of stock market bubbles, because it's that rampant speculation that we're getting, and we've seen a lot of examples of that in stocks at the moment. And that's really what's concerning me at the moment.
Yeah, and I think the industry is sitting back and watching what people are doing. So your big brother is watching you, so just remember that. And once they actually understand the way that people are going to respond, they're going to use that.
Oh yeah, absolutely. And we've got some examples coming up in what we're talking about in terms of some of the examples in the past that I had were Biota. I mean, Tesla's a big example at the moment. We've also got Afterpay as an example in the Australian market at this particular time as well. So there's a few different examples that we do have of it. But I want to talk a bit about one that I've seen, and there's an article in a newspaper article I read in the New York Times, and I think it came out on roughly the 8th of July. So we had a bit of a look at that.
And we're going to talk about that a bit later, aren't we?
Yeah, we're going to talk about that a little bit later on, but you want to talk about Biota at the moment, okay?
Yeah, look, that was one of the stocks that we were using as the example of where there's been a bubble essentially in a sector of the market, and then the stock's been completely crunched. And you can see we've got a chart up there showing what happened with Biota, and Biota fell almost 100% of its value. So you just wouldn't expect that a stock that had been talked about so much, that was trading up strongly, trading between $6, $8, $7 or $8, it wasn't a penny stock.
No, it wasn't. It wasn't. I remember so many different people calling up going, oh, I've got to get on a Biota, got to get onto Biota. And I go, why? And they go, because they're going to get the flu vaccine approved by the FDA in 3 weeks' time. So I've got to buy it now. And I go, but why? And they go, because it's going to go through the roof when it's approved. I said, it's already gone through the roof. Why are you jumping on at the end?
Yeah.
And then it didn't get FDA approval. It tanked. And this is what we're seeing on the chart. It tanked after that, and then people lost the money. And I think that did it about at least 3 times. I think they got knocked back before they finally got
what made it worse is this is around the time of the tech wreck as well. So there were a lot of stocks that were being completely slammed in the 90s and into early 2000 because of that, when the market pulled back. So this is just a casualty of it all. And it tried to continue on after that, and it just stumbled. Look at the chart, how it sort of tried to go up. It's being traded. Traders are trading that.
Correct.
And investors are thinking they're going to get their money back, but will never.
Yeah, and this is these people. If you look down here at the chart, you can see here after it crashed here through here, and people were just hanging on, hoping, and it took off, and they went, wow, look, if it gets back up to where it was up here, I'll get out. But then it went down and sideways again, then it went up, and then it went down. So for years, you really weren't making money. Now, Biota still exists now. It was actually merged with a US company. They've released the flu vaccine, blah, blah, blah. So it's now traded on, I think, the NASDAQ. So, but what causes a bubble? Well, it's rampant speculation. And when we see rampant speculation, then it leads to a crash. But simply what causes a market to crash is simply we run out of buyers. Now, because the buyers run out of cash, because it's generally the most uneducated that are pushing the market up in the last part. Because we always know that the professionals buy at the bottom and exit at the top, and the amateurs buy at the top and sell at the bottom. So what happens is the amateurs run out of cash, or people are just not willing to pay an overinflated price for that stock or the market in general. So what happens then is the market starts to tip over, and then the more it tips over, the more panic selling happens, and then it goes bang. And then added to this, we start getting short sellers in the stock, and then they start selling the stock, and then there's a big snowball effect, and it keeps snowballing down and down and down, and the more it goes down, the more people panic, the more people sell, the more it goes down. That's what causes the crash. So it's a pretty bubbles and booms and busts happen in stocks, that happen in markets, and there are stocks right now that we're having bubbles, and Biota that we showed you is an example of one of those, isn't it?
Yeah.
All right, I hope you did enjoy that section on the herd mentality and understanding what causes bubbles and how you can avoid getting caught in a crash after a bubble. Now, this next section is basically about Googling the top tech stocks. How do you use the online list to help you choose which stocks to buy? Now, tech stocks have been the flavour of the month, or were the flavour of the month during 2020, so it remains to be seen whether they are the stocks to buy into 2021. But in this section, we do actually show you how to find those and sort them out, so you can get a better probability of making more money and keeping out of those ones that are going to take your money. But let's get into that right now. Okay, so what we're going to do is just bring up, I'll put my glasses on so I can actually see what we're going to do, but basically we're looking at big picture first, and that's really what we want to do. So if you want to find stocks, if you want to trade stocks in the tech sector, you've got to figure out what they are. So looking at your screen, I just spent 2 seconds Googling this afternoon. I mean, I know where Janine and I go, but I just wanted to see what happens when you just Google top tech stocks, ASX tech stocks, and up came a site that you see here on the screen. It's just called List Corp, and these came up on the site, and you can see all these are tech stocks. Now I just clicked on market cap. You can see the little arrow there. And so if I click on it, it'll go from lowest to highest or highest to lowest. Now we want to trade the stocks with the highest market cap. Now a lot of people ask, why would you do that, Janine?
Well, look, I mean, a lot of people are trying to look for the next big winner or pick stocks that are still evolving and developing because they see that there's the potential for them to grow much more. But you're more likely, in terms of your probability, to make that 10 or 20% from a stock that's a big stock that, if that area of the market's going up, then it has to be the big stocks that are driving it anyway. And so the big players in the market, the institutions, will be putting their money into these stocks. But I mean, we're not promoting this particular website or in any way. It's just what, as Dale said, it's what came up in the search. But there are other sites as well that you can get this information from. So
yeah, there's quite a few, isn't there? I mean, I just typed it in just to show you how simple it is to find the tech stocks in the Australian market. You can find them on the ASX website. You can find them on Morningstar's website. But the S&P, I think it's at smp.asx.com.au is where you find lists of all the sectors and everything else. A little bit more complex, the website. I think I get lost in it every now and again, but that's where they make up all the indices for the ASX, so that's a place where you should go to get a lot of information anyway. But going back to the list, let's just have a quick look at it, and we can see here with the stellar rise of Afterpay, because a lot of what's been happening with Afterpay is it's on a euphoric rise of what they call rampant speculation right now. And what that means is every man, woman, dog and child's getting it or pushing it above where it should actually be. So it's pushed it right up into the #1 ranking on market cap at 19.94 billion. So if all we would do is just go down to the top 10 or top 20 and look at it, because these are likely to be the highest volume stocks in terms of trading volume. Now you've got the WAC stocks in here, you've got Xero in here, you've got WiseTechs in here, you've got Altium in here, you've got Appen in here.
You missed one. NXT, NextDC.
No, that's not a WAC stock.
Okay, you're looking at the WAC stocks.
Yeah,
okay.
WAC, so I'm just looking at the WAC stocks. So they're all in here. So I'd be looking at all of these. So I'd shortlist the top 10 that start off with, but then maybe you might even look out to the top 20 by market capitalisation, because you're looking at the biggest stocks. And the reason why they're the biggest stocks is because they're the best managed, they've got profits, they're doing well to be at that top. And they're the stocks you want to get in. You don't want to try and pick the speculative end of the market in hope and doing that buy and pray method that we talk about.
Well, that can change, like in terms of whether they're doing well or not can change from time to time. So you still have to keep an eye on the fundamentals and see what's happening with these companies. And the challenge with these companies is sometimes the fundamentals don't look great.
Correct.
But the chart can look really good. So this is where the criteria that you set for your portfolio in terms of your selection, you have to think about this in advance and think, well, okay, if I'm going to be investing in this type of sector, what term am I looking for? What time frame am I looking for? And am I just looking at whether the company's going up, or am I looking more deeply into it?
Can I ask you a question before I show the next little screen? Is how often have you spoken to somebody and asked them what criteria they have for selecting stock, and do they come back with an answer with a criteria?
Most people don't have anything.
Yeah. So what we're actually saying to you is have a criteria. What is your criteria for selecting a stock, and then how do you do it? That's really what we're doing. So the criteria is let's find the top 10 stocks in that sector. Next step we're going to do is go and look at the ASX website. And the reason why we're looking at the ASX website here, if you go to the asx.com.au and you click on prices and research, this tab here, you can see here, this is all the prices. So we go to company information, and then you get this list. And this is the list of every single listed company on the ASX in alphabetical order. So if I want to go to Afterpay, I just go down in alphabetical order, go down till I find Afterpay. And as I said, it's
Can't you type it in the search?
Oh, I probably could, but here it is. It's somewhere here. Where is it? Afterpay somewhere here.
Yep, right there.
There it is. Sorry, I clicked on the wrong one. You click on here. So when you click on that hyperlink, if I click on it, you'll see Afterpay details will come up here. Now you can see the daily volume, 3.4 million shares. You can see the market cap. You can see a whole lot of things. It's 52-week high and low, so you can tell whether it's liquid. So from a liquidity point of view, this is the second criteria, looking at what stocks are.
I mean, we've already looked that it's liquid, but how much does this really help somebody, this page? I don't think it does.
Well, it does in terms of liquidity. So if I want to buy a stock, I want to make sure it's liquid. So what's the minimum liquidity we'd be looking at? 3 million shares a day, or $3 million a day, or 5 million shares a day, or $5 million?
But that's like us giving them a prescription and telling them what they should look at. Is that what you're suggesting, that we should do that?
Yeah. So what should they shouldn't be looking at something that's only with, if the amount of trading is $300,000 or $400,000 a day, because that's very low liquid. So they need to be trading a stock that's in a few $1 million trading a day.
Yeah, I think the real test is to sort of look at it and say, well, okay, if you put X amount of money into this stock and you go and look on the market and see what the volume's like on any one day during the day, it really helps, because if you were to put in, $10,000 trade into a small stock, you're probably going to move the share price.
It could be.
So
yeah.
you know that you might not be able to get out of it. And it's interesting to watch it. We were talking, actually, I think it was last week or the week before, we had a guy on the show who was looking at the depth in the market, and we said that doesn't really help you. No. But when you're trading stocks at the lower end, it can help you, because if you haven't looked at that to see whether the volume dries up when the volatility in the market increases, then you'll have no idea about what the market would be like, and the market may dry up on you.
Yeah. So the last thing I want to show people, and if you just keep scrolling down, you see all the announcements. So have a look at what the latest announcements of. So once we've got that and have a look at it, saying we pick some stocks, we know they're liquid, we know there's plenty of volume going through the stock, so we like all of that. Then what we do is we then go to the fundamental data. So then we might go onto your broker site and look at its EPS, its dividend yields, is its earnings per share growing? So you want to see that over the next 1, 2, 3 years that its EPS is growing, and you want to see preferably it's paying a dividend. If it's not a big deal, but you do want to see growing earnings per share and dividend yield possibly. Then the last step that we take is going to the chart. So,
just to sum up where we've come to so far, because we've gone through this reasonably quickly. So what you're saying is that they can do a Google search to find technology stocks and find a list. The next important thing you talked about was looking for the biggest, most liquid stocks, because they're always going to move that area of the market, and narrow it down to the top 10 or 20 of those, and then go through and find a selection of them. So then it's about educating themselves on, is it some of the liquidity of the particular stocks. If they're higher market capitalisation, they're more likely to be liquid anyway.
Correct.
But then it's just narrowing it down, the criteria. So we're encouraging you to go away and set some criteria for your portfolio. So, for example, in your book you talked about certain liquidity. So I think we talk about it in the course as well. If it's 1 million units a week.
Well, it should be more in dollar terms. Always bring it back to dollar terms.
$3 million or something like that. If it's less than that being traded on any one day. Then
and we do have fundamental criteria in the book as well for people to filter on. So it's about finding the stocks and then applying some analysis to that. So some both fundamental and technical analysis. So most brokers' websites will have the fundamental analysis. So if you're looking at Afterpay, you'd go to the ComSec or whatever it is, look at its fundamentals, look at its earnings per share, look at its dividend yield, look at whether it's got growth potential from that point of view, and then you'd start bringing up a chart and looking at its trending and making sure it's trending well, which it is at the moment. I mean, it's trending up. But what you also want to find is stocks that have been, like a CSL we looked at, that's been trending down for a while, but it's got good fundamentals for when it turns, because you don't want to buy a stock after it's already run, and that's what a lot of people are doing right now, is getting into Afterpay, and it's been running for quite some time. So, all right, now we're going to take you through to a question which was answering a question that we had from somebody. When analysing the sectors, buy on confirmation and not speculation. And it's a real big question that a lot of people have, is most people think, or I get a lot of traders thinking they're buying on confirmation, but really they're buying on speculation. So Janine and I get into this topic. It'll help you understand what are solid rules and what is buying on confirmation, rather than what's guess or praying, or what I call a lot of times the buy and pray method, that people think they've done some research, but it's quite lightweight and it's not actually confirmation. So let's go and get into that one so we can give you some more education around that. Oh, it's mine next. Oh, I'm sorry.
You're next.
Stay awake, Dale. The next email we have is from Kerry, who says, "Hi, Dale. What about Janine?"
It's okay. I'm happy with that.
She goes on and says, "It's great to see an Aussie on YouTube for share market advice. I was wondering what sector or type of stock you would be more inclined to buy after market bottoms out next. Would you prefer tech, mining, finance, etc.? I was thinking of 5G and cloud technology. What sector do you think will do well? Thank you so much for your time and expertise."
Well, we just looked at some sectors, didn't we?
Yeah, we did look at the Janine and I don't think like that. I think it's probably the first one I want to answer is Janine and I don't think like that is because it just depends on what's going on. And 5G may be some good opportunities in there, but it may be a year or two away, before it really starts to take off and it's worth investing in. So it's not about that. It's looking at what sectors when the market does come down. It's, how do I say it? You'll probably hear me say so often, it's trade on confirmation, not speculation. Just because we think the market's coming down doesn't mean it will. The market could keep going up for Christmas because we don't control the market. The only thing that Janine and I can control is when we buy and when we sell. That's it. That we can't control anything else. And so we need to make decisions based on what the market's actually doing, not what we might think it might be doing. So right now what we're looking at is the market starting to move up again, as of the strong move last Friday, it really took off. And our market was up nearly 2% last week. So it looks a little bit better, but that says we still are thinking it's going to go down into the third or fourth quarter. But when it does come down, then we'll look at the sectors and look at, okay, what has been hit hard, what hasn't been hit hard, what are the stocks within each one of those sectors, and look for the opportunities within all of those. We're not going to pick that sector now. Is there anything you want to add to that?
Yeah, that's really good. I mean, financials is one, I guess, that we are not keen on, especially not at the moment, because it could be reaching its cycle peak right now and coming into it. So there's one. We'd rather see that sector fall away first. So industrials I really would like to see turn and move in the right direction after a bit of a pullback. I'd stick with that area. I think he's got the right idea going into some of the technology areas. I think that's really wise to have some exposure there, but just to have a mixed exposure at this particular point in the market's the wisest thing to do. Now, if you were to go into a few financials, then it would be very selective. Be very selective about the stocks in that sector and pick the ones that actually rebounded well during the COVID environment, not because of a lot of speculation, but more because they're big quality stocks like Macquarie and companies like that.
Yeah, and it really depends on your outlook for your investing, isn't it? So is it short, medium, or long term? And then that will then dictate the stocks that you're going to be looking at.
And the timing as well, because if it's more longer term, you can be forgiven for a little bit of volatility. But if you're looking more short to medium term, then you really need to time it much better into the market, especially when there's an opportunity here in the next, potentially 3 or 4 weeks.
Yeah, I think it's like to try and pick that right now is speculation.
Yeah,
I think that's
an opportunity for a peak potentially, and then
Okay, our last section for tonight is an interview that Janine did with somebody called Todd Miller. Now, Todd is a money coach from the US that we interviewed, or she interviewed only a few weeks back now. Todd calls himself Tightwad Todd, so you can imagine what he's good at. So he's good at making sure he's using money wisely and effectively, which a lot of people tend to struggle with. Budgeting, goal setting, financial management, a lot of people struggle with. Now, Janine's interview with Todd, she really gets into how to get your budget and saving goals on track, and he also includes a case study. Now, Janine and I keep saying to you, now is the perfect time to set down your goals, get your budgeting right, get your savings goals right, so that you can have the 2021 that you desire and move through to create your financial freedom. So there's some great pearls of wisdom from Todd during this interview. So let's get into that right now.
Hi everyone, welcome back again. I'm here to talk to you about Todd Miller, and that's the company name, Tightwad Todd. It's a fantastic business name, I just love that. And he's here to talk to us today about how to get your budget on track and your savings goals on track. And we've got a case study as we promised last time. So if you haven't listened to the last recording, make sure you check that one out. And this is a case study too. Hi Todd, how are you today?
Hey Janine, I'm doing great. How about yourself?
Yeah, fantastic, thank you. I've been so looking forward to hearing about this case study in the 20s, because young people, they'll have such a great start if they get going on this earlier, right?
Oh, 100%. Yeah, the sooner that you can start, the better your financial position will be as you grow older. It pays off, a lot to make those sacrifices early in life, because those sacrifices really pay off in a large amount as you grow older.
Yeah, look, so this case study that you've got for us, can you just give us a little bit of a rundown of the person that's involved?
Yeah, so for this particular case study, I met someone in their mid-20s who was out of school, I think about 2 years, and they were really struggling with sticking to their budget and saving money, really. Essentially, all the money that they made every month came in and then went out. So they really had a hard time juggling their finances to be able to start saving and planning for their retirement and their future.
It's that living from paycheck to paycheck that you were talking about. And it's not just in America that this happens. I'm sure it happens around the world because it happens in Australia as well. People get stuck in that because the marketing these days is just so incredible. People are just bombarded on the internet, bombarded on all sorts of other sources. You know, you've got to have this, you've got to buy that. There's all the peer group pressures, and it's particularly intense for young people. I think trying to, live up with the Joneses, as we would say here in Australia. I don't know if you say the same sort of thing.
We do, yeah. And I would also add that, young people are on their phone a lot more than other generations too. So while they're scrolling through Instagram and Facebook, they're getting all of these ads and, they're being constantly marketed to, which, that really skews their viewpoint. And like you said, it makes them believe that they need these products in order to really be accepted by their peers.
Yeah.
So that gets them to spend and to spend more and to spend carelessly and really take on debt in the most part, which really affects them down the road and prevents them from being able to achieve their goals.
Look, I remember when I was in my 30s, I was on an aeroplane and I watched this show on the in-flight recordings that were there. And it was about these marketing guys saying that we're going to tell you what you need to look like, how you'll feel, what people you need to associate with and how they should look. All of these things that were putting all this pressure on young people to go out and buy the latest, to have the greatest hairstyles, and clothes and brand names, and just to really put them in debt really early on. And it's just really tragic, I think, that people get caught up in that consumerism really young.
They do, yeah. And a lot of it does begin at an early age. I have a number of friends who got into financial trouble, as an 18 or 19-year-old when they went away to college. It seemed like a lot of the credit card companies would almost prey on young college kids. They would be there, offering free T-shirts and, a lunch or something like that to get them to sign up and to take out these credit cards. And many young people just aren't savvy when it comes to finances. So they, swipe their credit card here and there and don't really think about what it means. And they don't quite understand that there's interest that's going to accrue and that bill is going to come due one day. And if they can't pay, well, then it's just going to continue to grow. And it just kind of snowballs out of control for a lot of people from there.
Yeah, I think the key is just to how do you wake people up? And that's the problem. You want to wake people up before they get into that debt trap, before they even sign that form or fill out that application online for a credit card. It all sounds great to be able to have access to that money, but it's about, and all these new services now, Afterpay, we have here in Australia, and all of these different companies offering, I think in the years when I was in my 20s, they used to call it lay-by. You could go, I don't know if they still have that now, but you couldn't actually get the product. You would go into the store and you'd put some money down, and then the product would sit there in their store until you could actually pay for it. So whereas these days, you can take the product now, you don't even have to pay for it. So I just think, people are getting caught up in all this in the wrong way.
Yeah, it's certainly leading to some mass consumerism, which brings into question, spending habits of all of us in general and the long-term effects that's having not only on our wallets, but on the world and on the environment. And how sustainable is this consumerism? There's a lot of studies out.
Easily led, like you're going to talk about a study in a minute, but it just makes me, I think, always so easily led by these things. Are humans really that simple? I thought we were more intelligent, or I thought we'd progressed more than this, but obviously the data's showing that we haven't.
Yeah, it's kind of sad that, we're supposed to be the smartest species on Earth, yet there is a strong herd mentality amongst us, and that we want to, like you said, keep up with the Joneses and follow in the footsteps of our friends and our family. And it's really hard to break free and go against the grain and do the opposite of what everybody else is doing.
Yeah. You were talking about a study. Sorry, I interrupted you.
Yeah, so there's this day that's measured every year, and it's called Earth Overshoot Day. And this is the day that we essentially have expended all of the Earth's resources for what it can produce in a given year. Mm-hmm. And over the last 20 years, this date is happening faster. So we are consuming at a greater rate than we ever have in the history of the world. So we are consuming essentially about 1.5 times of what the Earth can currently produce. Okay. And that's just not sustainable. And there's going to be lasting implications from this consumer mentality that we have, not only on us, but on, our children and on our grandchildren. And it's just a scary thought to kind of go down that rabbit hole.
Yeah, the waste is just horrendous. They've got warehouses and warehouses of clothes, bags, shoes, all sorts of equipment and stuff that people have, discarded and they can't get rid of it. I mean, we have op shops and things like that. I know they do in America as well. And places where you can go and pawn, things off, and then somebody else buys it as a reused item, which I think is fantastic that we've got that cycle happening. But I don't think it happens enough. I think people. And I know when I had a child, and I know that probably people in their late 20s or 20s and 30s who are looking at having a family potentially, that there is a lot of pressure on people around you. Oh, why would you use secondhand goods for your children? I mean, to me, it makes a lot of sense to actually recycle. You can put them through a wash, antibacterial, all of that. That, when they go to play school, what do you think they're playing with? They're playing with toys and things that other kids have licked, sucked, and goodness knows what on. So to me, we've just got to get real about this and think further than just our own egos, I think.
Yeah, and just to add on what you were saying, you're right. They're playing probably with some kids, and then they're probably also playing in the dirt. I know my niece, that's like her favorite thing to do is to go and eat some rocks or put some dirt in her mouth. So what's the big deal if especially your kids are wearing some secondhand clothing? I don't think that's a big deal at all, especially when they're going to outgrow it, in a couple of weeks.
Yeah, and the environment. I mean, it's amazing the impact that can have on the environment. I mean, the nappies, when it came time to choose things like that, it was about choosing something that was environmentally friendly first. That was my priority. Now, I'm fortunate in that I could afford to spend a little bit more than other people, but I think governments need to start looking at things like that and because at the moment we put product of Australia. I'm sure that in the US that when there are consumer goods, it says on food, it says product of the US or wherever it comes from, right?
It does, yeah. So of course we want to take credit for all of the manufacturing that we do have here in the United States. So they're quick to put that label on there.
So we need to start doing that with other things as well. And really, we've actually got a cycle that they're trying to really put a lot of money in now, the government, on closing the loop so that the recycling process is actually a closed loop that we can recycle our own waste, which, this is where are we? We seem like we should have been doing this 20 years ago properly, but we're only doing it now because it was convenient just to ship it off overseas. But young people today, they're very passionate about these sort of things. People in their 20s are starting to really get smarter, I think, about this and really want to do something good for the world. So I hope there are more of those types of people coming to you.
I agree. I think the millennials and the younger generations are the ones that are really more aware of this. They're kind of leading this movement of what we would call sustainable investing and being conscious of their spending habits, what you would call like a conscious consumer, and the impacts that their consumption is having on the world, not just in how the products are grown and shipped and transport, but what happens to all of this waste and byproduct. And then, of course, there's a big surge right now in sustainable investing and companies only buying stock of companies that meet ESG criteria. Because I think there is a stronger concern about the long-term and the longevity of the world. Like you were saying with the nappies, we call them diapers, but that's probably one of the worst products that we have. I've read some of the articles on like the World Wildlife Fund, and they say that it takes somewhere around 400 to 500 years to break down one nappy, which is just incredible.
And I wasn't prepared to be part of that. I made a stand, but like I said, I could afford to, and if I'd encourage other people, families, like the parents of the children having the babies, pay for the nappies if you want to do something great for your kids and the environment for, your grandchildren. Pay for really, ecologically sound products for them. So Todd, I guess we can't solve the problems of the world in a 15-minute conversation, but maybe we can make a difference. That's what I'm hoping, and I'm sure you are too. What you can do and what you're doing every day is making a difference to people's finances. So would you please share with us that case study number 2?
I'd be more than happy to. So for this particular case study, this gentleman that came to me was 25, only about 2 years out of school, and was really struggling with being able to save any money. He had some student loan debt and some credit cards that he was hoping to start paying off and to save some money. Here in the United States, a lot of employers offer a 401k match, which is really just free money. Yeah. So we were hoping to help him start taking advantage of that and to start building his 401k in retirement. And then also he was hoping to buy a house in the next 2 to 3 years. So we were looking to start that fund for him as well.
Okay, awesome. Look, I don't know if you talk to your young people about this, but Dale's always been a big one for telling people, don't make your first house the home that you live in, just rent, buy an investment property, because in Australia, from a tax perspective, it actually makes financial sense to do that rather than to live in the house yourself. So I don't know if that sort of conversation comes across, but because the debt that they're taking on as their own home is non-deductible debt in Australia, then it actually puts people behind the 8 ball for years if they start off with the first investment being their own home.
We do have a similar conversation here in the States. There's a big movement here called house hacking, and that's essentially where you can live in a house or you live in one unit and then you rent out the other units of your property. Right. So for me, when I bought my first house, I bought a 3-bedroom, 2-bath house. I lived in one of the bedrooms, and then I rented out one of the other bedrooms to one of my good friends for about 7 years. And, he paid the majority of my mortgage for all that time period, and I was able to continue to save and grow.
That's smart, really smart. So what's he doing now?
Well, I'm not he's not hurting too bad. He's living a pretty good life out in Australia, out in Hawaii, getting a lot of surfing time in, so he's having a good time.
Awesome. Okay, so with this 20-something case study, so can you just tell us where it went from and to?
Yep. So with him, he was making about $4,200 a month, and his expenses also were $4,200. So along the lines of going in and adjusting some of these expenses, he was able to move in with one of his friends, which drastically reduced his rent expense and everything that goes along with that, like cable bills and utility bills. So he was able to save a couple of $100 there every month. So that really allowed him to put more money towards his credit cards, invest about 5% into his 401k so that he could take advantage of his 401k match, and then start putting some money into his future home fund so that he could get that done here in a number of years. But really, again, as soon as this credit card debt is paid off, that's going to free up over $500 a month in his monthly budget, which he can use to further fund his retirement or his house, and kind of build from there.
Yeah, it just blows me away that so many young people are getting the credit cards and they they don't even have a buffer or huge savings amount in case they get into some sort of trouble that they can use to get out of a spot like this. So that's really concerning.
It is. I agree with that. And I will put a little disclosure on here that, I almost always recommend that people start with an emergency fund before we start tackling debt and investing and that sort of thing. So just a little disclosure for all the viewers and listeners out there.
And look, with that, you've shown us a budget planner, you've shown us a pre-coaching planner and a compounding sheet that you've got there in a spreadsheet. So the compounding shows that, the amazing difference that this is going to make to this young person's life.
Exactly. Yeah. So if this young person was able to, save their $210 a month and get a yearly return of 6%, in 30 years, that's over $200,000, which is significant. And then, if they team up with you, Janine, maybe they can turn that 6% return into an 8 or 10% return. And then, they're going to have an even larger sum of money, in the years that come.
Yeah, that'd be awesome. Look, I'm really excited about this, and I hope that more people take up this opportunity with you and really make a difference to their lives. And thank you so much for coming on and talking with us again.
Thank you so much for having me on. I'm happy to connect with you guys anytime you'll have me.
Thanks, Todd. Bye for now, everyone.
Thanks.
Well, I'm sure you found Tightwad Todd or Janine's interview with Tightwad Todd very, very interesting. Now, we'll have more stuff from Tightwad Todd on our media that we do over the coming year. And as I said last week, we are introducing a whole lot of new things into our live show and into our YouTube channel for 2021. And we do look forward to bringing that with you. But again, thank you for being there for us in 2020. We look forward to being with us in coming shows in 2021, and we look forward to catching up live here on YouTube next week, 7 to 8 p.m. on Tuesday. So thank you very much and good night.